The next banking crisis won't arrive with sirens and headlines. It will unfold quietly, right up until the moment your money is frozen. In 2008, more than 400 banks collapsed, and millions of people watched their financial security vanish almost overnight. At the time, it felt unprecedented, but what's building now makes that crisis look less like a catastrophe and more like a rehearsal. The events that could shake the banking system in 2026 are already in motion, and if your savings are parked in the wrong place, you may not see the danger until it's too late. I know how this sounds. You've heard warnings before. Every few years, someone predicts a financial meltdown, and most of the time, life just goes on. But this moment is different, not because of fear or speculation, but because of structure. The groundwork has already been laid, and it's being reinforced by forces that are converging at the same time. Once you see how these pieces fit together, it becomes clear why major investors and financial insiders are quietly repositioning while the public remains unaware. The reason 2026 matters isn't random. It's the point where three separate pressures collide, creating a perfect storm for banks, especially smaller and regional ones. Each factor on its own would be manageable. Together, they become explosive. The first pressure point is commercial real estate. Between now and 2026, more than $1 trillion in commercial property loans will need to be refinanced. These loans were issued in a completely different world, one with near zero interest rates, full office buildings, and busy retail spaces. That world no longer exists. Remote work hollowed out office demand. Online shopping crushed brick and mortar retail. Property values have fallen sharply, yet the debt remains. Owners of these buildings now face an impossible equation. They must refinance loans at interest rates 2 or 3 times higher than before, using properties that are worth far less than when the loans were issued. Many simply won't be able to do it. When they default, the losses don't disappear, they land directly on bank balance sheets. This isn't theory. Across major cities, once prized office towers are selling for fractions of their former value. Buildings that were valued in the hundreds of millions just a few years ago are now trading at massive discounts. And while large national banks reduced their exposure years ago, smaller regional banks did not. These institutions are heavily concentrated in commercial real estate, and when defaults accelerate, they won't have the capital buffers to absorb the damage. The second pressure point is even more unsettling because it's largely invisible. Banks are currently sitting on enormous unrealized losses from bonds they purchased when interest rates were at historic lows. Accounting rules allow them to ignore these losses as long as the bonds aren't sold, creating the illusion of stability. During the pandemic era, banks poured money into government bonds and mortgage-backed securities, assuming they were safe. But when interest rates rise, bond values fall. It's basic math. As rates climbed rapidly starting in 2022, those safe assets lost hundreds of billions of dollars in value. The losses are real, even if they aren't fully recognized yet. These paper losses are concentrated in the same regional banks that are already overexposed to commercial real estate. It's a financial squeeze from both sides. When depositors begin to understand that a bank may be solvent on paper but insolvent in reality, confidence evaporates fast. We saw a preview of this in 2023, when banks like Silicon Valley Bank collapsed in a matter of days once depositors rushed for the exits. The third factor is the most complex and potentially the most dangerous. It's the massive web of derivatives that sits on top of the global financial system. These instruments are essentially contracts based on other assets, interest rates, or future outcomes. In theory, they manage risk. In practice, they concentrate it. The notional value of derivatives worldwide is several times larger than the global economy itself. These contracts are tightly interconnected. When one major participant fails, the shock doesn't stop there. It ripples outward, forcing losses onto other institutions. Many of these derivatives are tied directly to interest rates and real estate values, the exact areas under stress. If commercial real estate defaults surge while rates remain elevated, derivative contracts linked to those assets begin to fail. When counterparties can't meet their obligations, the problem spreads rapidly, turning isolated failures into a systemic crisis. You might assume that safeguards put in place after 2008 prevent this from happening again. That's the comforting narrative. The reality is that many regulations were weakened or rolled back, especially for smaller banks. The strictest rules apply to the largest institutions, while regional banks operate with far fewer protections. Even though they are the most vulnerable, regulators know this. Signs of preparation are already visible if you know where to look. Deposit insurance funds are being replenished. Emergency lending facilities quietly remain active. These are not signs of confidence, they are signs of anticipation. At the same time, bank executives are sending their own message through their actions. Insider stock sales across the financial sector have surged. These are the people with access to internal data, and they are reducing exposure. When those closest to the engine start moving toward the lifeboats, it's worth paying attention. The government and central bank are trapped in a dilemma. Allowing widespread bank failures risks a full systemic collapse. Direct bailouts, like those in 2008, would ignite public outrage. The most politically acceptable option is the least obvious one: inflation. By injecting liquidity and purchasing distressed assets, authorities can stabilize banks without calling it a bailout. The cost is paid quietly through reduced purchasing power. When money is printed to cover losses, savings lose value. Prices rise. Life becomes more expensive. The damage doesn't show up as a missing balance in your account. It appears at the grocery store, at the gas pump, and in your rent. Not all banks face equal risk. The most vulnerable institutions share three traits: heavy exposure to commercial real estate, large unrealized losses on securities, and a high proportion of uninsured deposits. Deposits above the insurance limit are the first to flee at any hint of trouble, accelerating collapse. This is why preparation matters. Understanding insurance limits is the first step. Keeping more than the insured amount in a single institution concentrates risk unnecessarily. Spreading funds across multiple banks reduces exposure. It also makes sense to think beyond traditional deposits. Short-term government securities, such as treasury bills, carry lower risk than regional bank deposits. Physical assets like gold and silver have preserved value across centuries of financial upheaval. They exist outside the banking system entirely. Maintaining some physical cash is another overlooked precaution. During banking disruptions, electronic systems can freeze temporarily. Having enough cash to cover essential expenses buys time and flexibility. Diversification can extend beyond borders as well. Some countries operate under stricter banking regulations and maintain stronger financial systems. Holding a portion of assets internationally reduces dependence on any single system. Digital assets like Bitcoin also enter the conversation here, not as speculation, but as decentralization. Held properly, they don't rely on banks or intermediaries. While volatile, a modest allocation can serve as a hedge against systemic risk. Preparation doesn't end with asset allocation. Knowing how crises unfold matters. The earliest stage often begins with rumors, then headlines, then sudden withdrawals. Speed is critical. Those who act decisively preserve options. Those who wait are often locked out. Government responses typically arrive after markets close, framed in reassuring language. Emergency measures signal seriousness, regardless of tone. Historically, the ultimate response leans toward monetary expansion, not restraint. The deeper damage usually comes afterward. Even when deposits are protected, inflation erodes real wealth. Hard assets and productive investments tend to adjust upward, while cash loses purchasing power. Can this be prevented entirely? In theory, perhaps. In reality, the imbalances are structural and long-standing. Years of cheap money, inflated asset values, and rapid tightening expose the weaknesses. There is no painless fix, only trade-offs. That's why personal responsibility matters. Auditing your financial exposure, understanding where your money sits, and reducing single points of failure are practical steps, not panic. Preparation isn't about predicting the exact date of a crisis. It's about recognizing direction and risk. If nothing happens, the cost of preparation is small. If something does happen, the benefit is enormous. The patterns that preceded past banking crises are visible again: excessive leverage, asset bubbles, rising rates, and hidden losses. History doesn't repeat perfectly, but it does rhyme. Whether the breaking point arrives in 2026 or shifts slightly doesn't change the underlying reality. The system is under strain, and pressure is building. Acting early, while options are available, is the advantage. This isn't about fear, it's about foresight. Staying informed, diversified, and flexible gives you control in an environment where many will feel powerless. And in times like these, control is the most valuable asset of all.